Very much. So good morning and welcome to today's session on limited company expenses. Hopefully this webinar will be designed to help you, especially if you're contracting or freelancing or a small business owner. It'll help you understand what expenses can be claimed, what are disallowed, how to handle them in a way to keep you compliant and hopefully tax efficient. So a little bit about me. So 2 seconds, I'm just going to change the slide. Here we go. So my name's Louisa. I am director at Aardvark Accounting. I've worked in the industry for over 15 years, supporting a wide range of clients from first timers to well-seasoned consultants and company directors. My focus has always been on trying to help people stay compliant, but also run smarter businesses, trying to help them make informed and confident decisions around tax, expenses, and long-term planning. At Aardvark Accounting, we are a small and professional accountancy firm specializing in limited companies, freelancers, and self-employed individuals. We work with our clients to try and reduce the time they spend on admin and compliance, allowing them to focus on what they do best, whether that's delivering work, developing new business, or growing their brand. We try to combine both expert advice with practical insight, offering clear guidance, whether that's just someone starting out or looking to scale up. What we're hoping to cover in today's session is what expenses can be claimed through a limited company, what HMRC doesn't allow, some key expenses that specifically relate to directors, how expenses impact both company taxes and personal taxes, some common pitfalls and grey areas, and best practices as well for record keeping. Now, as a limited company director, claiming the correct expenses not only ensures compliance with HMRC rules, but it also helps reduce your corporation tax. In this session, I'll explain how the right approach around expenses can impact both company taxes and personal taxes, particularly as well when it comes to benefit in kinds and P11D reporting. So let's say key principles in getting it right. So firstly, expenses must be wholly, necessarily, and exclusively for the business. They must be incurred during the running of the company, and you should ideally keep all receipts and records for at least 6 years after the financial year ends. Where there's also a personal element, for example, if the company provides you with equipment or vehicles, this may result in a benefit in kind. And these are typically reported on a P11D. But from 2027, HMRC are also going to mandate that most benefits must be reported and taxed through payroll, replacing the P11D. So again, this is just something to bear in mind, as this is part of HMRC's move towards real-time information. So let's touch on some expenses that aren't solely for the business and give you an example in practice. So a really common one that I get asked from people mainly working from home is, what if I buy a new sofa for my lounge? That room also happens to double up as a workspace. They think, yeah, I use that space for the business, so it counts as an expense, right? Well, HMRC might not quite see it that way, because the sofa is also used personally in the evenings by you, friends, family. So it's got a dual purpose, and therefore it's not allowable. However, if that same person buys a dedicated ergonomic desk chair for work, used specifically at their desk during office hours, that would be allowable. It's clearly and exclusively for the purpose of running the business, and that's always what HMRC is looking for. So key message is, even if something feels business related, if there is a private use to it, then it might not qualify. There's a few areas where we often advise clients to proceed with care. And as I said, first one being home office furniture. Also things like decorative or dual purpose items can be hard to justify. Coffee machines, home appliances are unlikely to qualify unless, again, there's a clear business setting. Electric car charging, that also needs some careful consideration, especially when charging is done at home. Cycle to work schemes, again, as long as the bike is used 50% for business, there can be a dual purpose. But when there's ever any potential for dual purpose, we always recommend getting some advice just in case. So let's touch on some actual harder expenses in terms of what you can expect to normally claim. So here's some everyday running costs that we'd normally see, and when you can claim them correctly, again, they'll help reduce your corporation tax bill. So I'm just going to run through some of these. So travel and mileage. Business travel costs, things like train tickets, parking, tolls, hotels, overnight stays are all generally allowable. If a personal vehicle is used, mileage can be claimed for 45p for the first 10,000 miles and then 25p thereafter. But a thing to note is that if you commute to a regular place of work, that doesn't qualify. It does need to be a temporary or client site visit. So meals, when traveling for business, the cost of meals and overnight accommodation can be claimed as long as they're reasonable and incurred during business trips. This might include hotel stays, business-related meals, incidental costs like parking. HMRC also allows a flat rate claim for incidental overnight expenses, which is usually £5 in the UK and £10 per night outside of the UK. And this just helps cover costs of newspapers, tips, and you don't need receipts for these items. Working from home is quite a common one these days. So if you work regularly from home, a portion of utility bills, such as electric, heat, water, sewerage, may be claimed. And this is usually calculated as a reasonable percentage based on time and space used. Or there's an alternative, which is HMRC's flat rate of £6 per week. Another one could be phone and broadband. So if you have a mobile phone, if that's provided by the company and the contract is in the company's name, the full cost is allowable. It's also good to note that the company can also provide each employee or director with a mobile phone handset, and that's also not got any benefit in kind issues. However, if the contract is in your personal name and you're running this through a limited company, then it can only be identified business calls. You can't put the whole cost of the contract through. Broadband is another tricky one. HMRC would say that if you already have broadband at home and the contract isn't in your company name, then you wouldn't be able to claim for any cost unless there is any significant increase for the business using the line, or if you have a separate business line. Let's move on to office equipment and supplies. So computers, monitors, keyboards, printers, office chairs, all allowable if purchased for business use. Stationery, ink, software, storage devices, again, all fall under this category. One thing to note here is that if any of the items do have any private use, there may be a benefit in kind on these. So again, you just need to consider that from a P11D point of view. We've then got things like professional services. So this might be fees paid to accountants or solicitors, business advisors. These are all allowable where the advice relates to the company. So that could be bookkeeping or contract reviews. Again, another thing to note here is that any costs that relate to any personal items, so for example, buying a property or any other personal matters, aren't allowable. Software and subscriptions. So this could be things like project management apps, antivirus software, cloud storage, Dropbox, Google Workspace. These are all claimable. Any industry publications, membership fees that relate to the trade are also allowed. We move on to marketing and advertising. This again can be a bit of a tricky one. So business cards, websites, social media ads, all other promotional materials are allowable as long as they help advertise the business. Sponsorship, that's where the grey area kicks in. So it is allowed as long as it's commercial in nature. So for example, sponsoring a local sports team is allowable as long as the company gains visibility or promotion in return. So that could be branded kits or banners. But it's not allowable to sponsor a family member's team just to support them, as seen in the Interfish case with HMRC, where sponsoring the managing director's son's rugby club wasn't considered a genuine business expense because there was no commercial benefit. Training and development. Training is claimable as long as you're refreshing or updating your existing skills. Courses to learn new skills or qualifications or retraining for a new profession are usually not allowable. Insurance. Business-related insurance policies like professional indemnity, public liability, or employer's liability are all fully allowable. In addition, there might be other policies like relevant life cover or death in service, which are normally claimable as well through the business, as long as they're structured correctly and don't incur any benefit in kind implications. However, on the other hand, you've got things like private medical or dental insurance, which if the company does pay for those, will trigger a benefit in kind charge. Entertaining. So, two types of entertaining. Normally, you've got staff entertaining and business entertaining. So with staff entertaining, such as a team lunch or an annual staff party, normally allowable for corporation tax purposes. It's not a benefit in kind, as long as, again, it meets HMRC's conditions. So open to all employees. An annual event like Christmas, and costs no more than £150 per head per year. Then on the other hand, you've got business entertaining. This might be taking a client out for lunch. This can be claimed through the business as an expense, but you just got to bear in mind that it's not allowable for corporation tax and no VAT can be claimed on it either, even though there is a clear business purpose. Salaries. So if a salary is paid to you as the director of a company, or if you pay a salary to your partner or spouse or other genuine employees, all costs associated with that are all allowable. Company vehicles, another big one at the moment. So a limited company can purchase or lease a car or a van, but if the vehicle is available for any personal use, then again, normally it triggers a benefit in kind charge. It's got to also then go on the P11D. For cars, the tax is based on the vehicle's list price, CO2 emissions, and the fuel type. Electric cars usually have a much lower benefit in kind rate, making it far more tax efficient. Vans are treated more leniently. As such, as long as there's no significant private use, there's usually no benefit in kind. Commuting is allowed, but again, any weekend or personal use would trigger a small taxable tax charge. There are loads of other ones that I haven't gone through, things like subcontractor costs, rent for the office, co-working space, donations, bank charges, the list continues. But again, it all depends on your own circumstances. Each of these expenses, you've got to make sure that you do support with a valid receipt, invoice, or log, and should be recorded consistently. If in doubt about whether something qualifies, it's always best to speak to an accountant before making a claim. So let's move on to expenses specifically for directors. So there are some key differences between what directors can do and what employees can do with expenses. And there are some greater flexibility and tax efficiency when these are managed correctly. So one of the key differences between directors and employees is the flexibility around pensions. And it's got some great tax advantages if you do it correctly. So contributions into a pension all reduce corporation tax, plus they're not subject to any national insurance or income tax because you're making use of not having to take that out as additional salary or dividends. Now, there's no hard limit on what the company can contribute as long as it passes HMRC's wholly and necessary for the purpose of the trade test. Now, each individual can only currently contribute up to £60,000 per tax year, and that is both employer and employee contributions in the tax year. However, you also can make use of your unused allowances from the previous 3 tax years, and you can carry those forward. Now, as a director, you can choose to either contribute a fixed monthly amount, or you can make flexible one-off contributions, for example, at the end of the tax year, which can be a smart way to reduce profits before corporation tax is calculated. Whereas for employees, contributions are typically limited to what the employer offers, and personal contributions normally come from taxed income, so tax efficiency is much lower. Now, another one that directors need to be aware of in terms of the limits are trivial benefits. Directors of close companies can receive non-cash benefits or gifts of up to £50 per occasion. Now, this is capped at £300 per tax year, but it is completely tax-free. Now, this must not be cash or cash vouchers, and they can't be as a reward for services or performances. Now, whilst employees can receive trivial benefits, these specific limits and conditions apply uniquely to directors, but they are a useful way to extract value from the company without triggering any additional tax. Now, one of the things I'm just going to move on to now is some disallowable expenses. So this is mainly where there's normally a larger personal element. So this could be things like holidays, streaming subscriptions, Netflix, Spotify. Normally we would say, don't pop those through the company. Clothing, everyday clothing like suits, general work attire can't be claimed. Instead, specific uniforms or protective clothing, costumes that may be required for that specific job. Any commuting costs, which is regular travel, again, as I said earlier, not allowable. It does need to be travel to a temporary location. Home improvements. So any expenses relating to your own home, renovations or improvements, even if you work from home, are normally again disallowed, unless they're exclusively for business use and don't have any personal benefit. Most fines and penalties are normally disallowable, even if incurred during business operations. This may include things like parking fines or speeding fines. HMRC's view is that these are avoidable and relate to breaking the law, so can't be claimed as a business expense. Non-business training. So as I said earlier, any courses or training that don't directly relate to your current business activity, such as personal development courses, are usually disallowed. Donations to non-registered charities or political parties are normally not allowed. Only donations to registered charities normally qualify for tax relief. So if in doubt, it's safer again to just seek some professional advice before including these expenses. So how do expenses actually impact tax? Well, any allowable expenses reduce the company's taxable profit, which in turn reduces your corporate tax. Any reimbursed expenses that you also incur, things like mileage or subsistence, are not taxable for you as an individual, and therefore, if paid correctly and supported by valid receipts, are a good way for the business to give you the money back for those. Also, for any VAT-registered businesses, VAT can be reclaimed on many purchases, assuming again you've got a valid VAT invoice, and these costs relate to the business. So let's talk a little bit about record keeping. So again, good record keeping is one of the most important steps in maintaining compliance. So advice would be, if you can, try and use accounting software. Things like Xero, FreeAgent, QuickBooks will make your life easier. You can normally snap and go. You can take pictures of the receipts, link them up with the transactions. I'd normally say to scan and store these and have digital copies. When you've normally got paper receipts, they tend to fade after a while. Try and record your mileage and your subsistence and any other costs as regularly as you can, just so that you don't forget them. Also, make sure you keep those receipts or any other documents for at least 6 years after the end of the accounting period, and try and then monitor the tax deadlines and submissions just to avoid penalties. So in regards to some common pitfalls to avoid. In order to make sure you're managing your expenses correctly, this is crucial for both compliance and tax efficiency. But we do see some common mistakes, which you should be aware of. So things like mixing both personal and business finances. Using personal accounts for business transactions can lead to some confusion and potential issues during tax assessments. So it's always advisable to maintain separate bank accounts for both personal and business finances. Claiming personal expenses as business costs. So, as I mentioned earlier, things like personal holidays, everyday clothing, home renovations, not normally allowable. These costs need to be wholly, exclusively, and necessary for the business. Don't forget to actually claim legitimate expenses. Failing to claim allowable expenses like home office costs, professional subscriptions, or pension contributions can result in higher tax liabilities. So regularly reviewing these deductions will help ensure that you are just claiming them. Not keeping records or receipts, again, can lead to disallowed claims if HMRC audits you. So having them digitalised and including them in your accounting software will just help you remain organised. Incorrectly claiming training expenses. Again, only training that updates or maintains existing skills are relevant. Anything new is generally not deductible. Misclassifying entertainment expenses. So earlier, client entertainment costs are not allowable. Staff entertainment may be, subject to those conditions. So it's understanding the distinction to make sure you avoid incorrect claims. Failing to track your mileage. Without detailed logs of business travel, mileage claims may be questioned. Ideally, you should maintain records, dates, destinations, and where you can, try and keep some receipts for times that you've put fuel in the vehicle. Not setting enough funds aside for tax obligations. So just making sure you actually understand your tax liabilities. You need to make sure that you reserve those funds, otherwise that can lead to cash flow issues. Regularly calculating and setting aside the appropriate amounts will just help avoid any penalties or interest for late payment. Sometimes delaying expense claims. So if you procrastinate on recording your expenses, that can result into forgotten claims and disorganised records. So try and implement a routine where you can in order to document those expenses. Sometimes, again, doing it yourself can lead to some issues because you're trying to navigate the tax laws and the regulations whilst also trying to run your businesses. It can be quite a lot to take on. So having someone there to help and a professional can just make sure that you're being compliant and optimising that tax efficiency. So some final thoughts. Only claim expenses that are clearly for business use. Try and keep documents and receipts well organised. Understand what's allowable, especially as a director, and try not to use the business bank account for all transactions. Make sure you're using all the reliefs you can for things like mileage, pensions, trivial benefits. And always try and seek advice if anything's unclear. It's far better to be proactive than reactive when it comes to tax and trying to unpick it all when you get to the end of the year. And that's it. Hopefully that was helpful. And yeah, I shall open the floor to any Q&As.
Thank you so much, Louisa. That was absolutely brilliant and definitely lots of food for thought about expenses there. Now, everybody, remember, if you have any questions about expenses, please don't hold them back. Please do pop them in the chat for us and we will get through as many as we can. And I've got a few from that were pre-submitted, so we will go through those as well. But just to kick things off with Julie's question there. So they have said, so new training, say a business is changing is not claimable. I think that's a question about training.
And changing the trade, ideally.
You know better than I do.
Yeah. So if your business is already in one trade and you are looking at exploring another trade, normally the expenses incurred for those new skills at the time would not normally be allowable for corporation tax purposes. However, if the second trade then actually became a trade and you started to bring in income from that new trade, you can then look to bring in those expenses that you previously incurred for that training, because then you've already then now started that trade, so therefore it would become allowable. But at the time, if it's then a new skill, it wouldn't be allowable until the company started trading.
That makes complete sense. Thank you for helping us with that question. So some of the pre-submitted questions, somebody had a question about how to use the utility charges paid as household expenses as our business expenses. So I know you covered that a little bit in the slides, but could we go over that just for that question?
Yeah, so well, you've got the easy option first. So if you don't work that regularly from home, the easiest one is normally HMRC's approved rate. Now it's not much, but it is £6 a week. You can just claim it. You don't need to do any calculations. You don't need to keep any bills. You can just claim the flat rate of £6 a week and be done. However, for those that do work more regularly at home, the alternative option is to add up the utility costs. Now, there's always some confusion about what you can or can't include within the calculation. But HMRC have said for limited company directors, it should only be the costs of the actual utilities themselves. So that might be, yeah, heat, light, sewerage, and water. You mustn't include things like council tax or mortgage interest or rent. Any fixed costs like that have to be excluded from the calculation. So once you've got all your utility costs, what you would then do is you'd look at your property as a whole. You would ignore things like bathrooms and toilets, and you would just look at the other rooms, so sort of lounges and bedrooms. And then what you would do is you would apportion those utility costs by the space used by your business. So that might be one room out of four. And then what you would then do is have a look at how much time you actually spend in that room, then also working. So if that's, yeah, 3 or 4 days, you would again apportion it by the days spent working from home. So it's quite a long-winded calculation if you try and do the alternative. But it's always best that, yes, if you do work substantially, have a look at doing the two calculations to see which one might be better for you, and then use that.
Yeah, that's absolutely brilliant. Thank you. A really good explanation of the two options. I think I'd end up doing the HMRC one because I'm lazy, but do you, and actually to add to that, like, do you find that there is a big difference when people do take the time to calculate it?
Yeah, so it's quite surprising by the time you've apportioned it by the rooms and then the hours, people sort of then get down to quite a low figure. And like you say, most people just go, do you know what? Rather than having to do this calculation every single month or every time I get a new bill, I'll just do the £6 per week because it's easy. But we do have some cases where people are working full time from home, and that's when it really does make a difference. You know, if you're doing 4 or 5 days from home, doing those utility costs, especially with the, cost of living increases, then actually that is a better option for those.
Oh, that's really good to know. Thank you. Viv, we've got a lot of questions about the sort of the learning aspect of the kind of expenses. So Viv has said, is professional executive coaching that supports the running of their business allowed to be claimed?
I'd normally say yes, if it was obviously again to help the trade of the business. So, in order to generate additional income, or there was something specific that you were being coached on again that the business is already trading in, then yes, I'd say generally that was normally allowable. When it's not, sometimes is when the training can be quite broad. So, quite a common example is if you've got someone studying for an MBA, even though that's in business administration, because the course itself is very broad, it can't really be identified as specifically for the trade of the business. So that one tends to normally not be allowable.
No, that's really helpful because actually Juliet's next question was that they are the managing director and they were interested in doing an MBA to improve management skills, but it sounds like that's not going to be claimable for them.
Yeah, normally, as I say, MBAs, I think there is a specific example on HMRC's guidance, which says that HMRC believes that an MBA is just too broad in terms of the skill set for it to be normally allowable for corporation tax purposes.
No, that's very, very helpful. And do leap, please don't apologise for all the questions. They are absolutely excellent. Keep them coming. Jeremy has a great question. Jeremy, I think I'm reading your question correctly. You are asking if you can claim for services purchased to create ebooks, courses, and programs to promote your business. So if I'm reading that right, I'm thinking maybe that's Adobe, Canva, the physical creation of the ebooks, and then courses and programs to promote your business
Yeah, I'd say again, but those sound like they would be genuine business expenses if you're using them to create materials that are going to be used by the business, whether that be for the trade or for advertising and marketing the business. Yes, I would say those are absolutely fine. Again, yeah, anything that's for specifically the trade of the business, there's not going to be an issue. Even if you've got some personal use of those items, that's probably going to be insignificant in comparison. So as long as it is incidental personal use on those items, absolutely fine.
Yeah, no, that's really good. Thank you. There seem to be some themes to these questions, which is excellent. So it looks like we're moving on to refurbishments of homes. So Sina has a jewelry business and she is fully refurbishing both her house and her studio. Now, the studio is a completely separate place. So can they or should they claim, and do they then need to ask the builder how much the refurb would be separately for the studio in order to claim?
This is quite a good one, and it's probably quite a grey area and a bit tricky to answer. So I'm going to probably keep it relatively broad. But if you are using a room in your house and it's within your property, normally any costs for refurb or redecoration or whatever it might be would normally not be allowable because it's part of your property. And therefore, you're increasing the value of your own personal home. However, if you've got a studio, which is, it could be in the garden, for example, or, not attached to your house, that's again where we get a little bit grey. So if the studio is a movable structure that could be owned specifically by the business, any costs for that studio, I would normally say would be allowable because if you moved home, you could really sort of take that studio with you and that's a business asset then. So any costs related to putting up that studio, kitting it out, whatever it might be, I'd normally say yes. If, however, the studio was in your garage that is attached to the house, again, we've got the same issue as before in that you're improving your own personal asset and it would stay there if the business moved on. So that one, yeah, there's a bit of a grey area and it depends on your circumstances.
Yeah, no, that's an amazing answer. And Sina very kindly gave some extra context saying that it's a garage, which you've covered off, which is really helpful. And I can see that Jeremy and Duleep had the same question about what happens if you convert a garage into an office. So we're saying probably not expensible.
Yeah, normally what we would sort of advise clients is things like, wooden log cabins, anything that again is a movable structure that you can put in your garden specifically as a business space. That, as I say, if you then sold your property, you could then take with you later on. Those are normally more justifiable. Or even if you actually have, a commercial space away from your home, it might be that you're renting out, a unit somewhere that is, there's no then personal element to that. Any costs associated with decorating, renovating that particular place would all be absolutely fine because there's no dual purpose. You haven't then got that personal and business mixture.
No, that is very helpful. And I'm very jealous to everybody who is converting their garage into an office. That sounds like a dream. Let's get to Julie's question. This is really interesting. So Julie has said, can a landlord claim for conveyancing on purchase of property and renovations?
So if you had a buy to let business, I'm assuming. So if yes, your trade was in buy to lets, and you were buying properties, then yes, any costs associated with buying those properties, remortgaging, any legal costs that you were incurring, like you say, conveyancing, any bank interest, if again you were running it through a limited company, all absolutely fine to claim as long as that's the trade of the business.
Brilliant. Hopefully that helps, Julie. Any other questions on that, let us know. Now, we had a pre-submitted question, and I absolutely love this one. This person has said, what are the hidden expenses that most businesses forget to account for?
I think it's probably, as I say, the nice to haves, which we covered. So it is things like the trivial benefits, because people forget that they can claim £300 a year as trivial benefits. Why would you not claim that? That's money that you can take out without personally having to pay any tax on it. Plus, you get corporation tax relief. Things like staff entertaining, again, it's not much, but up to £150 per year. That's a really nice dinner out, or it's, a trip away somewhere. And again, why not treat yourself? You've worked hard for it. The biggest one is probably pensions, in terms of that hidden one that people forget about, because you can contribute up to the £60,000 a year, and it's flexible. So it can vary year on year. Some years you might have some really high profits and you want to stick loads into your pension, but then the following year business might have not done so well. So it allows you to taper that down and reduce it again. But it's one of the biggest flexibilities that you have from an expense point of view to help reduce that liability down.
No, that's really good advice, and I feel like I'm hearing a lot about pensions and the importance of pensions at the moment, so it's a good reminder. So Duleep, you have said if a director is key to the operation of a business, can you take out either a critical illness or life insurance policy and pay it out of the company income as long as the company is paid as the beneficiary of the policy? Wow, what a fantastic question.
That is a really good question, and they've done some research as well. So the answer is it depends on the type of policy, but the gist of what you've said is correct, and it depends on how that policy is structured. So there are different types of income protection that you can put through the business. Critical illness might not be one of those, but there is an income protection one certainly that doesn't incur that benefit in kind charge. Now, as you say, the crux of it is who is the beneficiary of that policy. So if the beneficiary tends to be either you or a family member, normally if you were to put that through the company, it can still go through, but you would have that benefit in kind charge. If, however, the beneficiary is the business itself, so it's not again generating that income and the policy has to pay out, most of those, as long as they're structured correctly, wouldn't incur the benefit in kind charge. With those, however, it's normally best just to seek the advice of a financial advisor, because they can make sure that that policy is structured correctly and you've got the beneficiaries correct.
Yeah, that sounds like definitely worthwhile, but maybe a bit of a more complicated one. So let us know how you get on with that, Leap. I don't envy you having to try and figure that out with the insurance company, but it sounds like it'll be really worth it. So let us know how you get on. And another pre-submitted question we had, and this came up in a previous Unpacking Business Finance session that we did. So what are the best ways to record expenses as a startup, Louisa? I know we touched on this a little bit, but any kind of best practices there?
Yeah, so normally I would always say to try, if especially if you're a limited company, is to have a limited company bank account and then use that limited company bank account to record those expenses. So use your business debit card. The reason why is if you've got your transactions linked up to software, if you're using a debit card and you've got a bank feed set up that's automatic, each of those transactions is coming in individually every time for you. So then all you need to do is go on to normally the accounting software where you've got those bank transactions. You can then pick those, you can then explain them, say what they're for, add the receipts. It's really simple because it's already going into the software for you. Whereas if you're incurring expenses personally and using your own personal finances and using your own debit cards or cash, you've then got to remember to actively go on and enter those expenses yourself. And that's again where, you become a bit disorganized, or you get out the habit of adding them regularly, and then you might forget them and you've lost the receipt because, it's in the bottom of your bag somewhere, or, you just forgot to grab it at the time. So yeah, I would normally say straight through the business bank account, use the debit card. Try if you can link an app up with the accountancy software that you're using, because then you can snap and go. So if you're like me, you put the receipts in the bag and then you spill something in the bag or something gets crushed in it. Whereas actually, if you've got your app ready to go, you can put the receipt there, take a picture, add it on directly straight away, then forget about it. Plus, a lot of these places online will also do free storage for you. So again, it saves you having to back them up. They're all backed up in the cloud for you. They're just ready to go. And if you ever need them, you can just export them and you've then got them at your fingertips.
No, that's fantastic advice. And I know everybody's brain works differently. So if somebody's kind of not, like you say, not so good at doing it in the moment, that's okay. But how often do you recommend people kind of go through their expenses and do all of that admin?
Everyone's different. We have some clients who will do it daily. They will sit there and do it live, and they're really into that good habit and that good practice. Most others tend to do it probably monthly. They just normally sit down once the end of the month is finished and bring everything up to date. I'd say as a bare minimum, particularly obviously if you're VAT registered, to try and then get into the habit of doing it quarterly in line with your VAT returns, because then you can make sure not only are you getting the right corporation tax relief during the year, but you're reclaiming the right amount of VAT if you can during the year. It's much easier then to do it quarterly rather than trying to wait to the end of the year. Plus, also, your brain's a bit fresh. You remember actually what the expenses are for. If you try and do it once you get to the year end, you could have incurred those expenses, 18 months ago and actually forgotten what they were for. So the more regularly you do them, the more likely it is you're going to remember what it was for in the first place.
That is really helpful. Thank you. And as we are nearing the end of the session, we've got plenty of time for questions, by the way, but sometimes I know everybody has to drop. So I am just going to quickly say these questions have been fantastic. Keep them coming, but please do also bring them to one-to-one mentoring sessions, because as we've seen from the session, there's a lot of nuance, there's a lot of grey areas. So if you would like that additional support, please do book a follow-up one-to-one mentoring session with the accounting mentors on the platform. Now, sorry, Viv, I just missed your question. Viv has said, if we are capturing the images of the receipts through the accounting software, do we still need to keep the physical copies of the receipts?
I'd normally say no, as long as you're happy that the electronic ones are backed up. So obviously HMRC will not use the reasonable excuse of, I don't have access to them anymore, or my hard drive blew up. So yeah, do make sure that if you are keeping them electronically, you're happy that they are backed up. Normally with the paper ones, they tend to fade. I mean, I look at some of my old receipts that I had from 6 months ago and I can't read them anymore. So it is better if you can to try and have that electronic image, because you are supposed to have them for 6 years after the end of the accounting year. So it is easier then that way to have them. Plus also you can normally file them a little bit easier because you can actually attach them to the transaction rather than having to keep all the paper receipts in little folders on your shelf somewhere, taking up all that space in your house.
Yeah, exactly. That gives me the fear, like all of the storage. So that's good to know. Oh, Julie, this is a great question. This question is about how reasonable it is to frequently change your business laptop or phone. So would HMRC question it if a business is buying a new laptop or a new phone every year? Is it more reasonable to do it every 2 years? What's the kind of rule of thumb there?
I don't think there's a wrong or right answer to this one. I mean, really, I know some clients who do, they've always got the latest, iPhone that comes out every year. They've upgraded it because they want the latest one. I mean, it really depends. If the technology is not working for you and the equipment's starting to get slow and you just need a new one each year to trade, then that's absolutely fine because it is for running the business. What you've got to be mindful of is that if you are obviously getting new equipment and you've still got the old one, is that you dispose of it correctly from an accounting point of view. So if you are then selling that on, then the proceeds of the sale are being included correctly in the accounts. You're then taking into account any corporation tax implications of obviously buying and selling, because you get the capital allowances, but you also get balancing charges. So you just need to make sure that if you are changing your kit regularly, that obviously you're just letting your accountant know, or you're making the right changes on the accounts.
Fantastic. And Julie, I've seen your questions, we will get to it, but Duleep, your follow-up question there was, could you donate the old tech to charity, for example, a school in Africa?
Yeah, that would be absolutely fine.
Brilliant. And then I guess you wouldn't need to declare that or anything.
No, you wouldn't normally. Again, there are some rules about donating old equipment. So normally it's absolutely fine as long as there's no personal benefit to you for donating that equipment. So you haven't got some sort of interest in that company or wherever it is that you're donating it to. So as long as that's the case and it is an arm's length transaction, then it's fine. And if you've got something, even if it's just an email or a little bit of an audit trail to show that you have donated it, that's normally enough to suffice.
Brilliant, brilliant. And this might end up being our final question, unless anyone has any burning last minute thoughts. But Julie, I love this question. Julie has their first appointment with an accountant tomorrow and says that everything is everywhere. How do they start?
Okay, yeah. It depends on obviously who the accountant is and how they want you to provide them with your information because each accountant is different. Some people will only use software, others will use a mixture of software and spreadsheets, or some accountants will actually just let you turn up with a big bag of receipts and all your folders and just leave it there and they will sort that out for you in terms of bookkeeping. But then you would probably have to pay for that service. So I'd probably wait just to see how your chat goes with the accountant because they will probably guide you to how they would like to receive the information in order to make sure that they process it correctly for you. But I would normally say, if you've just got a big bag of receipts or invoices, I'd probably say try and put them in date order just to make life a bit easier. Perhaps put them in some folders, split down into months and years. That will just allow the accountant to get a grasp of the kind of work that they need to do. I'd also try and split it so you've got your invoices in one area plus your receipts for expenses in another. Again, if you're then getting a quote from the accountant, they'll be able to kind of see the income levels that you had during the year, as well as then the level of expenses to match that.
No, that is amazing advice and best of luck, Julie. I hope that meeting goes well. And it's always good to be getting things sorted and getting on track, isn't it? So well done for taking that step. I will stop the recording there just because I think we have got through all of the questions.